US tariffs come into effect upon the world in a matter of hours, and investors' hopes are being shattered by the day. There's now severe worry that we could be headed for catastrophic terms for markets. Here's what you need to know and consider. My name is Jessica Amir, market strategist here with Mumu this Wednesday, the 9th day of April. So overnight, we saw the S&P 500 initially rise 4% early in the session, and gains were quickly evaporated and the market closed down 1.6%. Now, this basically reflects what is happening in a bear market and what you could be expecting ahead. Markets are very headline driven. And the fact that we did see US President Donald Trump come out threatening an additional 50% tariff on China, all in all taking tariffs on China to 104%, with China now saying that they will fight back to the end. This is a huge concern that trade wars are indeed only picking up. It's not a very good setup for tech stocks, Aussie stocks, or commodities, all tied to economic growth, of course. But the pain didn't stop there. The oil price also fell below $60 US for the first time since COVID-19. And we are seeing the market's fear gauge creep further back up. It's now to a level of 52. Again, very similar setups to COVID-19. For those tuning in on the podcast, we're just flashing in the chart of ExxonMobil showing their shares are tanking. Of course, Exxon, one of the biggest oil producers. All in all, global markets are on eggshells, and we can't rule out that US and the Aussie share market, their losses could swell to almost 40%, similar to what we saw in COVID-19, with a drawdown of 37% to be precise. Now, that's what happened in the pandemic. And the reason I'm saying you can't rule it out now is because there are so many unknowns. What are those unknowns? Well, first of all, US earnings season, that's a big one. It's about to begin. Big banks report this week: JP Morgan, Morgan Stanley, Wells Fargo, Goldman Sachs, Bank of America, Citi. Next week, we get big tech earnings. The rug starts to be rolled out with Netflix reporting. The week after that, Tesla. Now, the most important thing on this key point is expect company earnings to be downgraded and outlooks to be downgraded. I'm just seriously concerned that we're probably going to see the biggest companies in the world pull their guidance and revenue outlooks for the year. If we see that, that'll send stocks diving lower. The second thing that you do need to consider is that companies could also pull capital spending plans and also lay off employees. That'll pressure stocks lower yet again. So as for what stocks you need to watch, I just want you to think about stocks such as NVIDIA that are really tied to companies' AI expenditure plans. NVIDIA is already down 37% from its record all-time high, but if big business cuts AI spending, you'd expect NVIDIA's losses to swell. The outlook for the economy, that's obviously expected to dim. So that means consumer spending facing stocks will probably see larger losses. Consider Apple's already down 33%. Amazon's already down over 30% as well from their highs. Expect their losses to worsen. Now, the third thing that I want you to consider is note that options markets are also suggesting that investors are bracing for more downside, and that's ahead of next week's Thursday option expiry. So these are the three scenarios and the three reasons that are basically implying that stocks are probably going to continue to move lower. So the next question might be, when do you maybe consider buying the dip? When can you expect stocks to move materially higher sustainably? Well, I say to you, markets, remember, we need certainty. Markets need to know what's coming for the next 6 months. We don't know that. Once we do have certainty around tariff levels, first of all, and secondly, once we get a concrete idea on what companies' outlooks are, and if they're not as bad as feared, then that's when you'll see stocks materially move up. Unless we have those two things, expect stocks to stay in no man's land. But for now, just brace for more losses. You're going to probably see stocks continue to be pressured as investors move out of growth stocks. They're moving out of commodity stocks and going into cash. But I do also want to throw up this other scenario. Do expect dip buying to perhaps maybe creep into some quality companies who are paying dividends. And also you might be expecting some small dip buying into quality companies with subscription models, because they're the ones that may be more insulated by tariffs and also see quicker recoveries once we see markets recover. So I just want you to think about these two examples: cybersecurity, subscription business, obviously CrowdStrike. CrowdStrike is one to keep your eye on. In the consumer business side of things, think about watching Netflix. They're the largest subscription model business, consumer-facing business. Also, rounding it all out, closing this off, I just want you to think about this. Coming into this bear market, we saw NVIDIA and AI chip stocks. They were the first to fall in the wake of tariff announcements. So my thinking is that they could be the first to recover. But as I said, the scenarios remain that we still need those couple of things before stocks move materially higher.